Take, for example, the American $700 billion. Just one case in one day. Of course, in the UK experience, there are almost an equal amount of money, or even more. And that's if you just take only this 700 billion, which was spent just in one day by the American government to try to do something about alleviating the pains. This is equal to a complete decade's insurance compensation for earthquakes, floods, etc. From year 1997 up to 2007, all over the world. All the earthquakes, all the floods, all the disasters that happened, including the United States of America, all over the world, for 10 years, they just spent $700 to compensate for this. You can just imagine the volume of the crisis we are in. And of course, the obvious point from this is that if the whole idea was just to try to finance housing and try to help low-income people to find housing, don't you think that just a small fraction of all of this, if it can just be paid on microfinancing basis or whatever the case may be, it could solve radical problem? Now we're carrying all that much cost to try just to save the financial system from trying to solve a very simple problem which can be solved much easier. And there are some constructive responses in the way. I'm just mentioning here Mr. Gordon Brown's call for a comprehensive review of the world economic system along the spirit of post-war Bretton Woods Agreement. And this has already been taken over by the United States initiative to hold a broad-based World Economic Summit on November 15th, just a few days ahead in Washington. And leading Muslim countries are invited, and it's very likely that the economic viewpoint might be expressed in some way or other in this meeting. I think this may be a constructive response, and we should be encouraging that so much. It's also remarkably inspiring time in modern economic history for us to consider the Islamic viewpoint. But it's also equally alarming for the burgeoning Islamic financial industry to learn important lessons from the current global financial crisis. First, we need to break away from the existing inertia. We seem to be just moving. We are being carried away by the wave. We don't have our own stamina to do what is appropriate in accordance to our Islamic vision. We seem to be just carried away. We are just trying to do things because people are doing them. And the second thing is about Muslims' housing needs, which is a dire need, and we have got to respond to that in the right way. As a matter of fact, the Islamic financial industry drifted into a wild impasse of intricate financial engineering, seemingly under the pretext of proving the ability of Sharia to satisfy all investment needs. This has been the motto of the day. Sharia is able to satisfy all investment needs. But as we can see, or I don't think you differ with me, what really matters is not the ability of Sharia to address investment needs, rather it's the ability of Sharia to address people's basic needs, like housing, education, health, nourishment, so on. And now that the insatiable greed and irresponsible behavior are blamed for bringing about this historic financial catastrophe, it is the right time to heed to Muslims' economic outcry for a more socially responsible Islamic financial industry. What's the problem? Actually, I'm so much indebted to my brother, Dr. Al-Tarqa, when he visited us in the Islamic Foundation just last month. And he gave a series of lectures. But one expression, I'm sure that everyone here might remember this expression. It was saying that the problem in Islamic financial industry is the lack of separation of powers. In the interaction of Sharia scholars and between Sharia advisors who are developing the products and Sharia scholars who are offering the auditing. And he gave the example of a judge who is also acting as solicitor in the same capacity, which of course doesn't make sense. I actually reflected on this point, and incidentally it was reminiscent to me to the UK experience of self-regulation, which came soon after the 1986 financial Big Bang. The Big Bang is a term which is used in Britain here to represent the radical structural changes which were introduced in the British system after 1986 in order to cope with the new innovation in financial markets. During the 1980s, arguments against statutory regulation within the British financial system were rife during those time, and it was very common to talk about the fact that we don't need any government intervention, we don't need any public intervention, we can do it all ourselves. And the proponents of the self-regulatory regime believed that statutory regulation was only a recipe for killing creativity and stifling financial market innovation. So professional experts of the industry, it was believed, were more qualified to tackle regulatory issues of their own industry than non-experienced government officials. As the face of it, it makes sense. And so the idea was to keep government at arm's length, and so that the official regulatory burden should be delegated to a handful number of self-regulatory circles. And the SRC, the SRC stands for self-regulatory circle, the SRC members were free to align themselves with any appropriate self-regulatory circle that matched the industrial activities. In the same way as many Islamic banks can freely align themselves with any Sharia board. Okay. So banks, insurance companies, pension funds, and various investment and financial intermediaries were typical members of different self-regulatory schemes. But the shattering blow came just from one thing. It came from the self-financing property of the system. And the same situation exists. I want to make things short because there are some slides which will come to explain this later on. In the Islamic industry, the self-regulatory Islamic industry is also self-financed. So this is a common factor which links the two. So it depended on membership subscriptions in both cases. And the other thing is there was competition among the SRCs for more members. This led to lower subscription fees and eventually to compromising the quality of supervision. And in British tradition, it's called competitive laxity. So the SRCs were competing for members, and this has led, this kind of competitiveness led to laxity in the supervision. So the supervision was not the issue, it was how to get more members. On the other hand, the inwards-looking view of industrialists who cared only for the industry, they cared for past and future affiliations within the parent industries, more than the interests of financial consumers. This was the other shattering blow of the system. So the self-regulatory system failed to protect financial consumers, and therefore it was inevitable to return to the statutory regulation, which at present we are having, which is the Financial Services Authority. This is a very quick overview of how the self-regulatory system started and failed in the UK system.